Perfect. Well, thank you, Jake, for getting this set up. Welcome, everyone. Thanks for joining us today. Today is Wednesday, May 14th, 2025. It's nice to see a lot of familiar names on there. We really appreciate you taking the time. Today, we have myself, Karina Olson, David Daughtry, Jake Eggett, and Ken Stern from Lido joining us. Just a couple housekeeping items first. So, as always, everyone comes in muted and off camera. There is that chat feature down at the bottom and the Q&A feature. Please feel free to use that throughout the presentation. There will be time at the end for Q&A, but we're happy to answer them throughout as well. This is being recorded today. Just like always, we will post this to our website in a couple of days. And towards the end, we will be going through our market economic update and have that slide deck. If you'd like a copy of it, just email your advisor. We'd be happy to share that with you as well. So today's format is going to be a little different than usual. As you may know, we shared some exciting news about Copperwind at the end of April. We sent out an email that let you know we're entering a strategic partnership with Lido Advisors. This is a firm that really shares a lot of our same core values and our unwavering commitment to all of you. So we wanted to bring Ken Stern on the line today, who's the president and one of the founding members of Lido, to join us. And so in a second here, I'm going to pass it over to David so he can share a little bit more about the upcoming partnership. Then Ken's going to go ahead and share more about Lido. After that, we'll jump into our usual market update and Q&A. So David, go ahead and take it away.
Thanks, Karina. It's a pleasure to be with you guys today. And to give you a little background, about 8 or 9 months ago, we started a strategic review of things that we wanted as Copperwind, as far as resources for you as clients and resources for our employees also. And we looked at 16 different firms that had some of those resources and ultimately found the best fit with Lido Advisors. And Ken Stern was instrumental in that. He is relentless on telling the story and the values that they have. And that's really what brought us into their orbit of saying, you do the right thing for the client all the time. And that's what we've been doing for 20 years. And so we're excited. Some of the resources that they have that we were just not large enough to have is CPAs on staff. So some of the tax questions that come up that we oftentimes will look and try and find through our centers of influence the answer to, they have CPAs on staff that can do that. People that can prepare taxes, estate attorneys that can help on estate planning, and a trust company if you need a successor trustee. So there's lots of things that they bring, as well as some investment strategies that we don't have that can provide some protection on the equity side, on the downside, which in a bull market nobody cares about. But since the first of the year, it's been sort of a top priority. How can we protect the downside? So I'll turn it over to Ken to tell the Lido story, but we're excited about joining Lido Advisors. We think it's the next evolution of where we want to be and stuff that we can provide to you that we couldn't in the past. Ken?
Thank you, David, and thank you, Karina and Jake, for having me and for those warm remarks. A little bit about me. My name is Ken Stern. I actually grew up in a town outside of Detroit, Michigan. And I've been in California for longer than I care to admit. Actually enjoy going out to Arizona. So this is actually really nice. In Utah, spend a lot of time in Utah and Arizona. So as it relates to, I have two daughters. They happen to both live in New York. One's in college and one is already on her way in her professional career. So before I get into the strategic partnership that David alluded to, which we're exceedingly excited about. I actually started a firm several years ago in San Diego, thinking about this idea back in the day where instead of thinking about transactions, thinking about planning and what incorporates planning and the holistic effect and how it all intersects and what's the net return after fees and taxes and how can you think about things more independently to take advantage of market cycles, as opposed to only thinking about some kind of a passive strategy. And as we continue to grow, I met a gentleman that started the firm, Lido Advisors. He was a CPA by training, decided he didn't want to do audit work, and actually started bringing families together to talk about best practices and what were they doing and who were they not working with and why. And we together formed this Lido Advisors to think about what it is that our clients need and to have this end-to-end solution. And with that, we are absolutely a mission-driven company. We are all about growing and protecting the legacy of our clients. We are fiercely independent. We have a fiduciary standard. It's always about the stakeholders, and the stakeholders are our clients. How do we do the right thing and continue to evolve to the best outcome? Our team members are one of those stakeholders. We want to have incredible opportunities for our team members to be stimulated and to grow and to do what they love to do, and putting them in what we say their highest and best so that they thrive. And then obviously in growing the value of our brand. So it's a company that we all can be proud of. And in partnering with Copperwind, it's a really, I'll tell you, we're a company that looks at growing by finding people that we are aligned with, that share that vision, that share that sense of community that we do. And with the more and more I got to know the team and the more I got to know everybody at Copperwind, we knew that this was the right alignment. Very involved in their communities, very, very involved with the client and the experience. And we're at that inflection point that we said, is there a jigsaw puzzle here that comes together so it fits not only seamlessly and beautifully, but it can be enhancing what we're all trying to accomplish? I obviously want to continue to help families that see the benefit of having these solutions that we put together and still being very, very involved in the community. And the team at Copperwind said, we want all that, and we'd love to be able to partner on some of these added values. If we want to be able to call an attorney because our client is going overseas and have a power of attorney to provide that kind of protection or peace of mind, or we want to look at a tax return and review it and come up with ideas and solutions, and to be able to have thoughts in a bigger collective. We call it an investment committee, but to be part of a bigger investment committee and this consortium to think about proactive strategies and to think about market cycles and iterations like you'll talk about today. So we spent a lot of time getting to know each other. We spent a lot of time thinking about how we can enhance all these things that are important to us. We call it this chassis, which is the end-to-end solution, the client experience, and all of that I had just discussed. And the more we talked, the more we knew that we wanted to partner. And here we are at this point, and couldn't be more excited and more enthusiastic about how we can do that and deliver just a continuing bigger and better value proposition for everybody. What I will tell you, and David or Karina or Jake, feel free to interject, or if you have any questions. What I will tell you is that there's a couple of driving tenets that are super important. And that's, it really, really is important first and foremost to what is the client's needs? Can we accommodate those needs? Do we have the service model that is literally encroached in any way, shape, or form with anything other than what is the client's best interest? What are the needs? And can we do that best? And we think about, before we decide to work with a client and before a client works with us, is this a good fit? And can we do that? And then we work like heck to actually deliver that and deliver on that promise. And very, very proud of the high retention of our clients. I think it speaks volumes for what we do. I'll also tell you another tenet is it's about the net return, meaning it's one thing to talk about experiences, but what is it that you're truly keeping? And that incorporates taxes, that incorporates fees. So we think about our team, and we're a little bit of control freaks when it comes to money. And the more we can, the term is insourcing, the more we can think about what can we do in-house to actually be more in control, to be accountable to you, and to lower fees to get that net higher, the more important it is to us. So we think a lot about that experience. If we can do it in-house, we will. And it's really important for us and nice to say we're accountable. And having that control is actually very important in the journey of where we're going, which is going back to the mission, which is growing and protecting the life and legacy of the clients and the families we serve.
Dave's on mute, but there we go.
All right. So sorry. Thanks, Ken. That was great in describing exactly why we looked and said it's a good fit for us and for you guys. So we look to have you on more in the future, and once the merger is done, which should occur in about a month, then we'll probably have a open house or something like that so that we can other people can meet you in person.
I mean, there's so much. I wish there was more going on in the news for us to talk about today, right?
Yeah,
But I mean,
exactly.
the fact is we are at an inflection point. We're in this pivotal period in the market cycle. And in addition, and in a bigger picture to that, I think a lot about what's happening with some of the what's going on in Washington regarding taxes. And I also think just personally about what and how, as longevity increases, I think a lot about our estate planning. I think a lot about who's in charge if there's an incapacitation. I think a lot about, I mentioned earlier that I have two daughters that I love to death. They're not married yet, so I don't have to apologize for the fact that I want to make sure that whatever I've built stays within the family and that there's controls and protections for what I call the bloodlines and the flow of funds and how that works, and what you're all doing and the work when it comes to this wealth planning and the holistic strategy over and above the investments. This is a really, really, really important time. There's just so many factors that parlay into it, and I compliment the work you're doing.
Yeah, we look forward to working and starting to use the resources that we have. So Ken, we'll let you go and tell the story and get all the work that you've got to get done as president and founding partner. But thank you for coming on and sharing the story and letting some of our clients over the last 20 years get to know the face of Lido.
My pleasure. I look forward to more of these in the future, and thank you for having me.
Thanks.
Yeah. Thanks, Ken.
Bye-bye.
Wonderful. Well, thank you, David, too. We appreciate that insight. I hope all of you guys appreciated getting a little more information behind Lido and putting a face to the name, too, with Ken there. We'll dive into probably the reason most of you are here today is to figure out what's really going on in this crazy world of ours with 2025. So I'm going to kick us off with a little bit, then I'll pass it to David to go over more of the economics, and then Jake to wrap us up with the market update. The big thing right now is the Fed is in a conundrum. There's a lot of conflicting signals in the economy, and it's making this policy decision really hard for them. There's the soft data that we look at and the hard data, and they're not saying the same thing or telling the same story right now. I'm going to be focusing more on the soft data, which includes the sentiment and expectations rather than concrete outcomes. So if we look at right now, really all eyes are on Powell. They've been on Powell for a while now. And the question is, what will the Fed do next? Last week, the Fed left the federal funds rate unchanged. It's been sitting at that 4.25% to 4.5%. This was the third straight meeting that they've left it that way. So at this point, they've really paused that rate cutting cycle, which began last September. And part of this is because they, same like us, they don't know what the future is going to bring here. And there's been, as I mentioned, there's just been this conflict and this predicament of what are we seeing today, right now, and what do we expect to see in the future? And what should we be listening to? And what should the Fed be doing with that? So there's two things I want to look at on the soft data side. One of them is going to be the inflation expectation. So that's the first one here. What you're seeing on the screen, I'll walk you through it first, is we have the kind of brown copper colored line, I think I'd call it. That's the 1 year expectation. And then the blue is the next 5 years. And these are expectations on where is inflation going. This is not actual inflation numbers, which those were released this week. I'll just share that real quick is current annual inflation rate actually did come down to 2.3% this week. It's the closest it's been to that target of 2% since early 2021. However, looking at this, what this is telling us, that brown line shooting up there to 6.5%, this is that consumers, that's you, me, that's, everyone around us feels that inflation is going up, that it's going to be at 6.5%. To put some historical context around this, if you look at kind of more the smack dab center of the chart there, 2022, the summer of 2022, the expectation was that inflation would be around 5%. What actually happened that summer is that's when we hit our peak at slightly over 9%. So if you're the Fed and you're looking at this, you're thinking, well, in 2022, the consumer was wrong and inflation actually ended up being even higher than what was expected. So the question now is this the same case? We're expecting 6.5. So is it going to be higher than that? Or is it going to be lower? Does the consumer see something ahead? Is this a leading indicator more so? The other thing to note on this and why we put that blue line, the 5 year expectation on, is you can see it's pretty stagnant there, kind of the same expectation for a while from 2022 onwards. And now we've seen this significant increase in where will inflation be over the long run. And one of the things, as I kind of just mentioned there, is this can be viewed as a potential leading indicator of is this where it's actually headed? Even though, as I mentioned, this week we got the good news that inflation's actually really low right now, as low as it's been for a while and closer to that 2% target.
Karina, one of
Yes.
the things that the Fed looks at here and why this is important is because the economic impact of if I'm a company and I'm signing a 3 year contract, if I think next year it's going to be 6.5%, then I want a higher price for the next year. And if it's 4.4 for the next 3 years, and that tends to then push prices up. Same way with unions and contracts. They look and say, well, if I think inflation over the next 5 years is going to be 4.5% a year, I don't want to agree to a 2% wage increase. And so those, even though right now their expectations can ultimately translate into economic decisions made on contracts and both on wages and goods.
Kind of a self-fulfilling prophecy, right?
Yeah,
We say it's going to be this, so people start believing it, and then they make it actually become true because
exactly.
they start acting on it. And it's the same with the next slide, which is about consumer sentiment too, where consumer sentiment, this is measuring how do consumers feel about the economy and their own finances, business conditions, spending, all of that. And what you're seeing here is morale is low. So that blue line shows where the sentiment is. You can see the significant drop. It's actually dropped for the fourth straight month, and it's one of the lowest levels on record. It's down a little over 30% from a year ago. And the reason why it should not come as a surprise to anyone, because it's the conversations we're having every day, is there's just a lot of uncertainty. If you've met with us recently, you've heard us use those words too. And the market doesn't like uncertainty. We don't like uncertainty. And there's these fears of inflation, which we just touched on. And that's really dragging it down. Is also with inflation, you're thinking too, is there going to be a weak labor market? Are we expecting lower income growth? And all of that is making the consumer less confident. And when someone's less confident, do they stop spending money? So that's part of this self-fulfilling prophecy is right now consumer spending is still fairly solid. But if we're feeling like the economy is going in the wrong direction, do we stop spending, right? And will that then in turn down the consumer spending at the end of the day? The other thing to point from the historical context here is you can see the last time this was really low in recent years was in 2022, in the summer of it, when we had high inflation. And the market in 2022, I don't think I need to remind all of us, but it was not pretty, right? The phrase we kept using was there was no safe place to hide. And if you're the Fed looking at this now, it's that same question with inflation is, should we be concerned? Is this going to happen again? And that's kind of this conundrum that they're in is this soft data is suggesting that there's a lot of economic anxiety. There's a lot of things we should be concerned about. And as we said, this could be a leading indicator, right? This could lead to, do we need to take action because something is coming? The thing I haven't mentioned yet, too, the other kind of question mark here is everything with the tariffs happening of what we know today might not be what we know 3 months from now, 6 months from now. All of that's factoring into what is the Fed going to do. But at the same time, we said it's this conundrum because the current hard data is telling a different story. So, David, tell us what we're seeing in the actual hard economic data right now.
Yeah, and that is there's a big disconnect right now when you start looking at, and we'll start out on some of the easy stuff, consumer spending. And this the consumer spending is 68% of GDP. So if the consumer is doing well, GDP is generally doing well, and vice versa. And this is actually, they call it real final sales. And real means adjusted for inflation. So this is not that things are going up, as far as consumer spending, because prices are going up. They're going up because they're buying more things. This goes all the way back 70 years. And what you see, the gray areas where the columns of gray, that's where we were in a recession. And generally, you think when you're in a recession, consumer spending trails off some for a while, and then you recover. And you saw this really sharp drop in the pandemic and quick rebound as we reopened. But when you look at the trajectory of that line, it's steady, up to the right-hand side. That's where it's going. As long as that is the case, the economy is generally in a good place when you look at that. Now let's look at it in the context of the entire GDP. If you go to the next slide. We like colors, so we got all kinds of colors here. The consumer spending is the purple, the darker purple. The black line is what GDP is doing each quarter, an annualized number. And so you see the last 2 or 3 years, it's usually between 2 and 3%, 2 and 4, but generally between 2 and 3, except this last quarter where it was slightly negative. And people are saying, oh my goodness, it was negative. Are we going into recession? Well, if you look at all the other stuff, from the consumer spending to domestic investment, really strong. The lavender color, the big lavender column that's in the pink area, the pink is negative. That is imports, effectively, the net imports. They call it net exports, but it's really net imports because we have a deficit. And what happened is everybody knew, because President Trump had telegraphed we're going to have tariffs. Well, if I know something may go up in price, what do? I buy it now. And that's what everybody did in spades in the first quarter. And so that really dwarfed everything else. The rest of the economic activity was not materially different. So that huge import, influx probably drops dramatically, and you're seeing it in April and early May in the ports already. So next quarter, you're probably going to see somewhere between 2 and 4% on GDP. We're not.
David, that kind of reminds me of what we saw this quarter. It's similar, different situation, but similar to what we saw post-COVID, where all of the imports were stuck off the coast there of Long Beach. And so we had 2 quarters, one where it looked like we imported nothing because they were just sitting out in the ocean waiting to come into the country. And that was in Q4. And then in Q1, everything finally was able to come in. So I think it is
and we had a negative print that quarter. And yet,
exactly.
At the time, we said, don't worry about it because this doesn't have anything to do with general economic conditions. So yeah, it's the exact same situation, except it's instead of we can't unload the container ships, it's the tariffs that have been put in place here. Yeah. Everybody probably trying to front load that. So yeah, but this hard data, you would say, oh, that's bad because GDP dropped. it didn't really. It's more of a math issue that will, it's self-correcting probably next quarter over the next 2 quarters. Now, if we look at the employment, if people have a job, they tend to spend money. People spend money, economy is doing well. If you look at the unemployment rate, and this goes back to the last 25 years, anytime we're near the 4% level, it is really good economic times. You saw the huge spike in unemployment at the pandemic, and then reopening, it comes down dramatically. But at the 4.2% level, that is a really strong, economy as far as the jobs market. But as we know, people say, yeah, but how do they calculate what the unemployment rate is? You have to be out of a job, but you also have to be looking for a job. And so then we say, well, why don't we just look at how many people are working? Is that going up? And what we see is absolutely it is. So when you hear people say, oh, we never recovered from the pandemic, we absolutely did. I mean, you look at that and you're probably 8 or 9 million people more now than are working than were pre-pandemic. And you're not seeing a slowdown in that. I mean, it's a steady, upward trend, just like we were seeing in consumer spending. So you've got that data that really shows we've got jobs that are solid, plenty of people working, consumer spending is really good. But everybody sees the elephant in the room, and it is the potential trade war here. I do think that being able to get the trade deal, or at least a framework of it, done with the UK and now with China, I think that takes some of the fear off of we're going to get a full-blown trade war, because a full-blown trade war is bad for everybody. There's no winners out of something like that. And so I think it looks like less likelihood of that. And so I don't think the sentiment numbers, at least on the sentiment of consumer sentiment of, it's a lot more uncertain. I think it's fairly certain jobs are still going to be good, number of people employed good. Will the tariffs that stay in place cause some inflation? I'll give you one bullet point, one data point. It was a research piece done by Goldman Sachs a couple of weeks ago, and it was showing that their analysis, if you have a 10% increase in tariff on trade coming into the U.S. across the board, that increases CPI by about 1%. So you go from the 2.3% reported to now 3.3% or higher. That could cause the Fed not to lower rates, but actually raise rates. So there is still some concern on the soft data as far as inflation, I think. So with that, let me turn it over to Jake to talk more about the markets.
Yeah, thanks, David. I think that was, really helpful for us to kind of see, hey, here are some leading indicators on the soft data that Karina kind of walked through, and then David to kind of walk through some of the hard data, which tends to be more of a lagging indicator. Markets have been pretty volatile, as you can expect, and I'm sure you have seen and watched your portfolios over the past 4 or 5 months. A lot of that has been due to the tariff uncertainty, but also I would probably add to that just higher valuations contributed to the decline as well. The chart you see here is just the S&P 500 since the start of the year. You can see that the market dropped nearly 20%, really from kind of mid-February to early April, and then has staged a pretty impressive comeback. Now, we're not all the way back to the highs. We still got another 4% to go, but we have recouped the losses that we saw since the first of the year. And it's been a pretty impressive comeback. Anytime that you've seen markets drop 20%, it usually takes a bit of time to recover. This has been a pretty sharp reversal, which has been nice, and partly due to, I think, some of the things you said, David, which is, if some of these trade things go away that have been causing the uncertainty, most of the economic data shows that, companies are still growing, and we can continue to see the market do well. So, but I do want to highlight just two things relating to the market that I think is worth noting. One is valuation. So some might ask, why does this matter? PE ratios, price to earning ratios, can only go so high. And what the chart here shows is just the historical, 25 years of data of what the forward PE ratio is. And just for for ease of explanation, all a PE ratio is price to earnings. It's basically saying, what is an investor willing to pay for $1 of earnings from a company? So if it's at 20, investors saying, I'll pay $20 for $1 of earnings. What you notice is that the typical forward or the average forward PE ratio is kind of in the 16 to 17 range. It tends to get expensive when it's above 20. When it falls below 14, it tends to be cheap. And the markets over the past 10 years have mostly stayed on the expensive side. You can go all the way back to the year 2000 during the tech bubble, and things were really expensive then. We're not too far from that. So things certainly, as the market came down in April, things got a little cheaper. As the markets kind of rallied back, we're back into that 20 to 21 times earnings right now. David, you've said it best many times, going back to the tech bubble. The markets can stay overvalued for a really long time, right? I think when you look at, what was it, David, when you talked about the
So if you
Alan Greenspan time?
Yeah, Alan Greenspan, he was famous for making the comment about the NASDAQ having irrational exuberance as far as a price standpoint. And everybody now looks back and say, see, even the Fed chairman, I mean, he said it was expensive. The problem was he said that in December of 96, after which you had three of the best years the market ever had. So it can, go up for a long time. John Maynard Keynes, who was where we get Keynesian economics, he was a money manager in the 30s, and one of his famous quotes was, the market can remain irrational longer than I can remain solvent. And so, when somebody takes a bold move and said, oh, it's too expensive, I'm going to go to cash, you're taking a lot of opportunity risk here that, things go, the other way. And what we've seen here, in fact, we've had a couple of, numerous client conversations of, when the tariffs were announced and the market dropped dramatically, well, why don't we go to the side until the market comes back and settles down? When it comes back, as you showed in, on the graphs, I mean, it comes back in a hurry, and generally, it's hard to get to that. That's one of the reasons they say, well, what if you could avoid, the worst, drops in the market, the biggest drops, and only be there and capture the up days. They're nearly always at this, very close to each other during a bear market. So you look, and we've said before, you get a China thing, you could, you could have a jump of 1,000 points or more in the market. Voila, that's exactly what happened.
Yeah. And I think the last 10 years kind of shows that
Yep.
same story, right? I mean, you could argue it's been more expensive over the last 10 years, and we've had a good market, even though we've had several really big declines. So
Yep.
the other thing I would point out too that we've been watching closely is the dollar. Dollar tends to have a very long trend. What you're looking at here is a chart of just an ETF that we follow that tracks the dollar relative to other currencies like the euro or the yen or the pound. And what you see in the chart is, if the chart is going up, that means the dollar is strengthening. If the chart's going down, means the dollar is weakening. And for the last, I would say 10 plus years, for the most part, the dollar has strengthened against most currencies around the world. The last 2 to 3 years, you've seen it be really choppy. You've also seen it kind of be flat from a trend standpoint. There's been times where, it was really high and then it's come back down and kind of reverted back. And right now, over the past 6 months, we've seen the dollar declining. When the dollar weakens, it bodes well for international stocks. It also bodes well for commodities. Um, Gold is a great example of that. I mean, over the past year or so, probably due to a couple of things. One is, dollar weakening, but also to what Karina kind of pointed out too, which is inflation expectations. You've seen gold have a really strong trend. So I think the thing that we're looking at here is, if the dollar continues down here, what does that do? One of the things that it's done for us is we've been able to add some more international exposure to the portfolio, something we haven't owned for a really long time. That's been very helpful. They tend to be, at least right now, the international tends to be valued a bit cheaper than the US is. But this is something that I think is on our minds. Does this just kind of revert back and the dollar continues to strengthen from here, or do we actually continue to see the trend come down from the high levels that we've seen over the past 10 years? So from a summary standpoint, I think a lot of clients just want to know, what have we done with this market turmoil? And, certainly when markets become volatile, it becomes very challenging from an investment standpoint. One of the things that's very important to us is to follow trends. But we also want to make sure we're protecting if we go into a much longer trending downturn, we want to be able to protect portfolios to not go down as much and try to smooth out those rides. So I'll just maybe point out two things that we've done both on the stock side and on the bond side. On the stock side, just given the trend of the dollar and then some of the volatility, we shifted to international. We started to do that early in February in our rotation strategy. We added a little bit more in March. And so we have exposure to both international developed markets like Europe and Japan. And then we've also added some exposure to the emerging markets as well, think Brazil's of the world. And so that's been one way that we've kind of add broader diversification. We took a little bit of risk off when the market was choppy. We've since added, a good portion of that back in. And then we also shifted a little bit where we were heavier on the large growth side. We shifted back more to the middle, so we have more of a blend, a kind of a balance between growth and value. That's kind of currently where we're situated. On the bond side, just as the stock market has been volatile, the bond market's been as volatile. Maybe not in terms of magnitude, but certainly in terms of the bond world, it's been really choppy. As our models do, as the trend starts to move down, we'll go to the sidelines and protect and be in treasuries or money markets. We did that with floating rate and high yield bonds. We've since added those back in. So we like the yields that we're getting. We're getting about 6 to 8% yields on most of those. And then we've also added some mortgage-backed securities into the portfolio. They tend to have a little bit higher credit quality, still pretty attractive yields, and we can benefit from the high mortgage rates that we currently see right now. So, I would say overall, we're cautiously optimistic. We're optimistic because the markets tend to go up over time. I think we're a little cautious because of some of the uncertainty that Karina and David had talked about. And the trends seem to be recovering. We'll see if they can continue on from here and hopefully have a good second half of the year. So we'll continue to kind of let the models kind of allow us to help make those decisions and kind of take the emotion out of the investing. And overall, I think we're pretty positive about where we've gone so far to May. So still got a lot to go through the year, but
Jake, one of the things I wanted to add here, if you look at first quarter earnings, about 80% of the companies beat on the earnings side, about 60% beat on the revenue side, which is actually a little bit below average. But what you are seeing is so many of these companies where you were saying forward PE, the forward guidance, they're yanking it because they're just saying we can't in good faith predict what might happen, because if tariffs, are completely suspended, we're going to make more money than we told you. But if the tariff war continues, I mean, it's unclear what they're going to make and what disruptions and all that. So there is still a lot of uncertainty there. So, it's harder to estimate what earnings are going to be. But the China deal and the UK deal have given some hope to the market, I think.
Yeah, and I think it's nice that we've been able to be more diversified than we've been in a long time. I think that will help smooth out some of those returns for sure. So, why don't we shift to Q&A? I know that there's some questions that have come out. Karina, do you want to maybe touch on some of those?
Yeah, thank you both, David and Jake, for chiming in there. I think the takeaway too is there's a lot in wait and see right now across the board for the Fed, for us as well. We have some questions that come in. Don't forget there is that Q&A feature down below if you want to submit a question as well. I think going back to the first part of this, Jake, if you can share a little more on what will the Lido transition look like?
Yeah, I mean, we're super excited about it. As David and Ken kind of talk through some of those resources, I think first and foremost, our team stays intact. We continue to work with our clients in the same capacity that we have. We're not going anywhere. I think it was really important for us to make sure that, we maintained our relationship with Schwab, so accounts will stay the same. When you think about any type of partnership, there's always change that occurs, and we know that that will be the case to some degree. I'll give you an example. I mean, our website will change. It will go to Lido, right? Our name is changing. But in terms of like our phone numbers will stay the same. You can still reach out to our team, whether it's Amy or LaShondra or Kim that you reach out to when you call and need something, or any of the advisors or paraplanners or junior advisors. We're all here to support you. I think one good thing too is like our technology, for the most part, will stay the same. So not only with Schwab, the accounts, but also like our performance portal. They use the same software that we use. Also, our financial planning portal that we use to kind of run the retirement plans, that continues to stay the same. So that's really positive. And I think at least for us, ways that we can help our clients more is like the biggest thing of why we did it, right? It kind of goes back to what David described as, hey, if we can get some more resources on the tax side, on the estate planning side, and expand our investment team, that's ultimately going to help us help you more. And so for those reasons, we're extremely excited about it.
Yeah. Thank you,
Anything
Jake.
you guys would add to that?
No, we are excited. I mean, I think it'll even on the investment side, some of the stuff that they're doing on downside protection, I think will be a nice addition to our current portfolios.
Yeah.
Yeah, I think you said it great earlier today when we were chatting, Jacob. It really should not feel all that different on the client's end. It's probably going to feel a little more different on our end, but in a positive way of just additional resources for us to do our jobs better. And that's what we're here to do at the end of the day. Well, thank you for hitting on that. So a question did come in. Will the minimum portfolio change with Lido? I can take this one here as far as when it comes to our fees, our minimums, the way Copperwind's operated, that's not changing, right? So if you're a client today, you will continue to be a client with us. We are still here to do what we do at the end of the day. Same with if you refer friends or family to us, we are happy to evaluate their situations and help them. So long way to say no, we're not changing as far as who we're able to serve and how we're able to help everyone out.
Yeah.
The other questions, feel free to put more in if you have them about Lido, but I know some questions came in more related to the market. David, I'm going to pass this one to you. I've been getting this a lot in my meetings lately, but what happened in the bond market earlier this year at the end of March, early April?
So one of the things when President Trump announced the tariffs, the market dropped dramatically. And then a few days later, he comes out and said, we're suspending them for 90 days, and it rallied dramatically. And everybody said, oh, he didn't like the drop in the market, and that's why he suspended the tariffs. That is not the case. The case was what you alluded to. Generally, if the stock market drops, the bond market goes up. Why? Because money that was in stocks goes to bonds, treasuries in particular, because they're the safest, and they go up in price, down in yield. The exact opposite occurred. Stock market went down, treasuries went up in yield and down in price, which everybody says, what's going on? And basically some of the powers that be on Wall Street were yelling into Treasury and into the president of something is wrong here. And that caused the pause, because about a third of all of our debt is held by foreigners, either foreign central banks, governments, or individuals. And the thought was, are they starting to sell treasuries? And that's what's causing the yield to go up and the price to go down. If your biggest lender that you're relying on starts to say, I'm not going to lend you any more money, you need to pay up, take notice, because when you got $37 trillion worth of debt, it's a problem. So that was what happened. It seems like it sort of reversed itself, and now as the excuse me, now as the stocks have been going up, then you're seeing people getting out of bonds and moving back over. So it's sort of back to normal, but that was scary, and that's what they say. In fact, I can't remember which president it was that said, in his next life, he'd like to come back as the bond vigilantes because they control everything. And that is really the case. I mean, when you're needing to find another $2 trillion to fund the deficit every year, you can't afford to make people not want to own your bonds. And I think that was the concern.
Yeah, I mean, you've seen the 10-year Treasury. I mean, when things started to move down, I mean, you saw the 10-year get down to around 4%, and now it's back up to around 4.5%, close to.
Yep.
So there's been some big moves on the bond market for sure. And
Yeah.
that's one of the reasons I think we favor, investments on the bond side that have lower interest rate risk right now.
Yeah. No, and the reality is higher rates for longer. So the Fed not lowering rates right now, that's for the portion of the portfolio that is on the bond side, and for most clients, it's 30 to 50% of your portfolio. That's a good thing, because we're getting that 6 to 8% yields every month. We're clipping the coupons, and where I think now a lot of the Wall Street types are saying it's probably November, December timeframe before you start seeing any reduction in rates. And the conundrum, we talked about the conundrum of the soft data versus the hard data. The real conundrum is what happens if we start to fall into recession, and so unemployment goes up, and their two mandates are full employment. So all of a sudden they got a problem here. And at the same time, because it's tariffs, you've got rates going up and inflation going up. What do they do? And that was actually asked in the last press conference at the FOMC meeting. And Powell's comment was, we'll look at which is the furthest away from our target and go attack that first. I suspect it's nearly always going to be on the employment numbers, because if inflation goes up a little bit, if as a consumer, it hurts me a little bit. I lose my job, it hurts me a lot. I mean, the financial pain to families will be much greater and much more acute if it's a job issue instead of an inflation issue. But that's the conundrum they're going to have, and that's why they're not willing to lower rates right now, even though the economic data probably points to that's what they should do if everything was equal. But you've got this out in the future sort of cloud hanging over of, are we going to have a tariff war? So.
Yeah, and maybe the other thing to kind of add to that is just back to that, the debt comment that you made, right? Is that as interest rates are higher and more bonds roll over, we're paying a lot of money in interest right now. So
Yeah, and the problem is nobody is addressing that in Washington. And it was I mentioned earlier that I watched a congressional hearing where the Secretary of Treasury he was asked point blank. So on the proposal that you guys are talking about on the tax, tax and spend piece, is that going to increase the debt? And Besant, who is the Secretary of Treasury, said, "Well, if you look at it as a percentage of GDP, and I can't remember if it was a senator or representative. No, answer the question: is the debt?" He never would, because yes, debt's going to go up by $1.5 to $2 trillion a year in perpetuity, basically. But nobody wants to address that on either side of the aisle. Biden didn't do it. Trump's not doing it. Congress is not doing it. I mean, it just and it will come back to bite us in the rear end sometime in the future. You can't continue this forever. But as we were talking about the irrational exuberance, it's just like the market. It can probably go on further than we think. But I think when it stops, it will be quicker than we think.
I think that's something, David, that we've included in a lot of our previous webinars on the long term. Our debt as a country is something we
Yep.
continue to have our eyes on, and it does worry us on what will the outcome be? What is the solution? What does that look like? Right? I think today, short term, we're so focused on tariffs, what's going to
Mhm.
happen immediately, but that is a long term concern that we do have. Kind of changing gears too, I want to make sure we have enough time to answer the questions that are coming through. One of the other things, Jake, you mentioned this earlier, so I'll let you start off with it. You talked a little bit about gold when we were talking about the dollar, but tell us more about gold and if it makes sense as an investment right now.
yeah, I mean, gold has had a very strong trend over the past few years, specifically over the last year. And I think two things that are really happening. One, you have a dollar declining, which I mentioned, right, which is beneficial
Mhm.
to it. But you also have this inflation expectations, and as you can see it in the consumer sentiment, people are worried about inflation, right? That is a big concern because we've all seen prices go up, and gold has historically been a pretty good hedge against that. The thing about gold is it's a volatile asset class. It generally isn't a huge part of our portfolio. Right now, we own it in our rotation strategy and have owned it for over a year now in there, which has had some nice gains. But when you look at gold historically to the market, if you go back 50, 100 years, historically the market's done much better than gold. But there's times where gold does better. I mean, we've seen gold have a really strong year this year. I think if you look back to what was it, 2011, Dave?
Yeah, for
Mhm.
about 10
Gold,
years there, it went down and it took 10 years to get back to even. So,
yeah, it took a long time. And those are years where the markets did pretty well, right? So we like having it as part of the portfolio. It's generally never going to be a huge component of the portfolio unless, a client wants to have more exposure, but generally that's where we've been able to add it, and it's, I think, been a nice diversifier here over the last
yeah.
year. So
But it is different than stocks and bonds because stocks and bonds typically pay a dividend or interest rate, and gold, to own it, if you especially like it in an ETF or something like that, it costs you. It's not generating. It's a pure. I think it's going to go up in value or hold its value. That's why I'm doing it. Not I'm going to make a lot of money off of it. So.
Yeah, I think that's really helpful to hear. And also, I know a lot of you on the call have heard us talk about our rotation strategy too. The benefit of that is it is following the trend. So it will pick up on the times where gold is doing better than some of those years where you mentioned maybe we didn't want to be invested in it. I think that covers the questions. Jake, David, was there anything else that we didn't hit on that you'd like to add before I wrap up here?
No, just we appreciate, the loyalty and the friendship and stuff as we work with you. It's always a challenge to go through the markets and the economics and the political things that are going on, but We love what we're doing because we get to work with you guys and we get to hear your stories and see your successes, and it's very fulfilling. We don't, it's always interesting. I'll text Jake or Karina, over the weekend or in the evening, and it's always, hey, did you see this on, there was an article about that, and they're doing the same. So even when Karina's up on top of a mountain or Jake's hiking on top of a mountain. So, so we appreciate
I
all of
don't
you guys.
answer while I'm biking. Yeah, well,
Yeah, go ahead.
well, I was just going to say thank you, everyone. We truly appreciate it today. We talked about a lot of things, especially I know there's some things we talked of the changes in the portfolio. If you have specific questions about your own accounts, your own plan, just reach out to your advisor. We're happy to have a quick phone call, quick Zoom, in person, or sorry, in-person meeting, whatever we need there. So please feel free to reach out. Thank you again, everyone, and we look forward to seeing you soon.